You're listening to the Rite Retirement Show.
The 70% of people out there listening to the show today are going to need some level of care. It doesn't necessarily mean that 70% are going to end up in a nursing home, but 70% of people will need some assistance out there. The biggest fear is running out of money for the retiree, but what we see is not enough people spend enough of their money.
Cris prides himself in what matters to you. This is the Rite Retirement Show.
Hi there, I'm Lou Ann Fulmer. Welcome to the Rite Retirement Show with certified financial planner and financial advisor Cris Wallace. Cris is president at WG Financial Group, and then also joining us from the firm is Graham Bauer. He's also a certified financial planner and financial advisor at the firm. So they're both here today to give us some really good advice about retirement planning. They always share such good information, hot topics that are happening. If you have any questions that as you listen to our show, you have, here's how you can reach out to us. 256-937-2010. Remember, this is a complimentary visit, 256-937-2010. You can call that number. You can text the word visit if you prefer to do that. The other thing, check us out on Facebook throughout the week because we do this show earlier in the week. And if anything else happens throughout the week, any news headlines, Cris will update that on Facebook always. So just search for WG Financial Group. 256, our motto, plan, retire, and play. That's what we want for you in retirement. We're going to be talking all about that today. Remember, this show is available anywhere you get your podcasts, on Spotify, Apple, wherever. Just search for the Rite Retirement Show. And Cris and Graham, hello to you both.
Hello, Lou Ann. How are you?
Lou Ann.
Hi there. Great to be back with you guys. I've been off a while, and I am now a grandmother again, so I feel really old. 5th grandchild now, guys.
Congratulations.
Man,
Thank
congratulations.
you.
That's awesome.
Yeah.
So the name of the show, we got it right.
Yeah, you did.
Or you got it right. You remember.
Right.
Is that supposed to be a pun?
Show.
It was kind of.
I got it right.
But every time at the office, do you ever feel like, not awkward, but just weird when you say, oh, yeah, right. And then, because everything we do is right. Retirement at the office.
Yeah.
Right?
Yeah, I mean, the layers of puns can go really deep if you let it. So, but you got to stay professional and just keep it to only 1 or 2 layers of puns, not let it get to the point where, you're just getting way out in the jungle of RITE, right, puns.
Yeah, and if it's used too many puns, it's not punny. So
yeah.
It's not punny. Cris, you are full of it today. Oh my goodness.
I am.
Oh my
well, congrats
goodness.
again to you. Grandmother times 5.
Yeah. Wow. I know. 1 boy out of the mix and then the rest are girls. My son has 3 girls.
This wasn't the first boy though, right?
No.
Okay,
We got our little boy from my daughter, and my son now has 3 girls.
Wow.
Oh, man.
Do they start to act a little disappointed when they find out it's
I'm
another
telling
girl?
you,
I feel like I would.
I was so deflated for him. They did a deal where they cut the cake, and it was going to be, the inside was either going to be pink or blue. And the little girls were, one of them wanted a boy, one of them wanted a girl. And Dylan goes, I don't know. I'm just too nervous. And I'm like, I was so nervous. They cut the cake. And Dylan goes, it's a girl. His voice was really high.
Well, he's broke. He's go
broke.
ahead and just file bankruptcy today.
Yeah, we'd say, sorry, you can never retire.
Exactly.
There's no way. There's no way we could swing that.
He needs to get a hold of you guys.
He does, yes.
Yeah, but no, you know what? She's so precious, little girl. Franny Lou is her name, and she's teeny tiny.
Oh, wow. I love
Sweet
it.
girl with a bunch of hair. Yeah, so
I love it.
It all, when they're born and you see them, you don't care. You don't care what they are,
No, they're alive, and that's a blessing.
And healthy, yes.
Mm-hmm,
So, yeah. So all good at the Fulmer household.
Awesome.
All right.
Awesome.
So now, Graham, you sent me this reel for our Real Talk last week. I thought it was something you guys used on last week's show, but no, it's for this week. So I'm excited for you guys to get into this.
We did a rerun last week.
Oh, you did? Okay.
And the reason for that was we are moving in our other office. We're basically staying in the same building, but we just literally moved down the hallway.
Uh-huh.
And so, we were supposed to have already moved out. And so we get to the office to record, and the building manager's like, are you moving today? And we were like, no, we weren't planning on it. So then at the last minute, here we are running around the office.
He's
moving.
like, yeah, you are.
Yeah. You should have seen us with trying to dolly up file cabinets and push them down hallways. It was quite the sight. We're
what a mess.
We're no two men in a truck, but we did what we could.
Yeah,
oh my goodness.
We did. So crazy. Anyway, so that's why last week there was another rerun.
Gotcha.
So we apologize for that. But yeah, let's get into real talk. Graham, I'll let you kick it off here.
Yeah. So, as you guys know, we can't play the actual clip, but essentially what was being discussed was, performance and fees, mutual fund fees, that is, or I guess I should say just internal expense ratio fees. And, the host of this show was talking about, the balance of that and, saying something along the lines of, well, if I could get 3 or 4% more return, like, why would I care if I'm paying 1% or 1.5% in fund fees? And his essential message was that fund fees are the last thing he looks at because it's just historical performance is all that you should, look at and care about and try to get the best return. And, I would say that is definitely not the philosophy that we have on this subject. And I don't think that the data really can fully support that statement, or at least not to that extent that it should be the main thing you look at. Finding information about, performance on passively managed and actively managed. And just to go over the difference real quick, it's probably kind of obvious, but I'll just hit on it for anybody who doesn't know. Passive is kind of what it sounds like. So if you're looking at like a passive index fund or ETF, something tracking like the S&P 500, it's going to have, a basket of stocks to mimic the S&P 500. And really the only changes that are being made if there is a change in a company that is or isn't weighted in the S&P 500. So, there's not like a fund manager going in there, moving stuff around all the time, selling some positions, buying large amounts of other ones. They're just really trying to mimic a certain index, where active would be, they might sort of somewhat mimic an index like S&P adjacent, but there will be an actual fund manager that is going in and moving things around with the intention of trying to outperform the, whatever index they're kind of comparable to. So there have been a lot of studies done on which one, actually outperforms over time. And I will concede that it's kind of a weird thing to look at because some years it's better than others. Some years, 60% of actively managed funds might, do a little bit better than passively managed. Other years, only like 25% will do better. But if you look at a historical average, you look at like a 10-year plus timeline, it's really somewhere around, 60 to 70% of passively managed index funds and ETFs do outperform actively managed ones. So in my opinion, it's kind of a gamble on picking one because, sure, there is the potential that you're paying a higher fee, an internal expense ratio, and you get more return. That's a possibility that could happen. But I mean, if my chance of that happening is 30% on average, 25% on average, something like that, rather than just knowing I can just track an index, pay a little bit less, no matter what happens. I mean, that's the route that I'm going to go. So, I mean, Chris, kind of let you put your thoughts on this, but those were kind of my initial thoughts when listening to it.
Yeah, I thought this was your show. You just run off with it. So, no, it's good. No, great, Graham. No, excellent here. I actually went out and pulled some stuff as you were talking, and you're spot on. You said 60 to 70% underperform. The average, according to the SPIVA report, SPIVA, 65. So spot on there. But let's dig a little bit deeper and look at it from 2005 through 2024. All domestic funds, 97% underperformance. And if I just look at the best one, where over that time frame, let's see here. Yes, the 83% was the highest or the best underperformance, let's put it that way, of all of the different asset classes. So this ranges from mid cap, small cap, real estate, all small cap core, small cap value, large cap value, 83% underperformance from 2005 through 2024.
Wow.
So if you look at, to your point here, if we're looking at trying to target an index, it's probably not, a mutual fund's probably not going to be the best way to do it, especially an actively managed, because they woefully underperform 83% in that time frame. And then if you couple that with the average expense ratio, so I did a quick Google search again while you were talking, so I was glad you took that and ran with it because it gave me time just to kind of punch in a couple notes. According to the little AI that Google provides at the top now, which is kind of nice, actually. I don't know if you guys, have you noticed that?
Yeah. Sometimes I like it for a quick answer.
Yes.
Gemini, right?
I think it's Gemini, something? Right. It's a quick summary. So what they said was 0.25 to 1%. So then I went to Investopedia, and Investopedia said the average mutual fund expense ratio 0.5 to 0.75. And then it went on to say that 1.5 is considered really high. And I was like, yeah, that's really high, especially if, the advisor's charging on top of that. I think what we're trying to say here is not looking at the fee and just looking at performance can cause a problem if you look at the data, because the data doesn't support actively managed funds. It doesn't. And then you couple that with a fee that's higher than, say, your normal ETF or your index fund, and then you've got underperformance with that. It's kind of a disaster mixture of things that can happen to your returns over time. So I think what we try to do at the office is we're looking at lower cost indexed or ETF type funds that are targeting more of an index. And that's what we're trying to do there, because that lowers your fee overall. That also can potentially increase your return long term. So with this particular reel, again, very famous person kind of talking about this. This person has several mutual funds that they prefer, and we're just not on board with that, just because we tend to look at the data. And if we look at when we're sitting down, we're working with a family and we do our little Rite Retirement report card that we come up with, anything higher than 0.2 in a portfolio, we consider high. So if you're, 0.2 or higher in expense ratio, that's considered high. And we should be working on a plan to kind of drive that down. We've had people come in the office. Graham, there was one particular portfolio I'm trying to remember. It's been a couple of years ago. Do you remember? It was a husband only came. It was just a husband, and he'd been to another advisory firm, and it was nearly 2% in average fund fees.
Yeah, I think if I remember, it was like around 1.88% or something, just under 1.9.
Plus their advisory fee.
Yeah, not including that. So, you're looking over 3%.
Yeah, in that case, it was over 3%. Yeah. And gross total fees between expense ratio and then also advisory fees. And we can't say the name, obviously, but it was grotesque when we did our analysis on that particular portfolio. So our philosophy is target more of the index, come up with a balanced approach to retirement planning, and try to use fund fees or use funds that have lower expense ratio. So that's kind of the real talk. We're not on board with that reel.
Yeah. Yeah. And I like to say, because the person that made this, they often talk about similar things to this, and, we'll recommend talk about mutual funds and then recommend asset classes of mutual funds, but never the actual fund tickers. So I'd be really interested to see one that has 50 years of performance outperforming the S&P or something like that.
Right.
Because the longer because you went further back than I did. I was looking 10 years, but it gets worse as you go further back, and then
correct,
it's harder to study past then. So the longer you get, the worse that kind of looks.
If I remember right, the words from that reel was, "What do I care if the fund is charging 1% if I make 4?"
Yeah, if I make 4 more than the index does. And it's I'd love to see one that makes, that's been averaging, 14% over the last 50 years, 70 years. That would, I think you'd be hard pressed to find it. Maybe it's out there somewhere. If it is, I'd love to know about it.
Yeah, I would too. I would 100% love to know about it for sure. So anyway, again, that's Real Talk this week. So
the second kind of element to that I can jump into, because I think this ties in really well, and we are going to talk about it.
Okay.
Anyways, is the tax drag element is what we would call it of mutual funds,
right?
Versus ETF investing, tax deferred investing. And we would say this more so mutual funds held in a brokerage account. So like a non-qualified, non-retirement type account, which is something you see quite a lot. So just to kind of illustrate what I'm talking about here before I get into, I have a few examples, and if you don't like math, this might be kind of boring, but I'll try to get through it quick. But I think some people will find this interesting. So if we just applied some of this to just a CD first to kind of illustrate the point, if someone made, let's say, they're still working and you're making $300,000 a year, adjusted gross income is the number I was using here. And you have, a CD that pays, 5%, and the total interest on that is $10,000. So you generate $10,000 of interest, from your CD, and, that's all taxable. So you make $300,000 a year. You're generating $10,000 of interest. You're going to have, obviously, to pay federal taxes on that, and that's going to bring your return down. So in the initial example we did, after factoring in, federal taxes as well as NIT taxes for their, modified adjusted gross income.
Can you explain what NIT tax is for those that don't know? Yes,
yeah, I can. So an NIT tax is not something that your average person is going to run into a lot, but we see people that probably aren't aware that they've paid it before. So essentially, it's an extra tax on your investment income, net investment income tax, when your income is over a certain amount. So the modified adjusted gross income limit is $250,000 if we're talking about a married couple. So on that, if you generate, $30,000 of capital gains, or basically any investment income, interest, dividends, capital gains, things like that, that are considered investment income, they will have an additional 3.8% tax on them over and above your federal tax rate. So they'll still be taxed at the capital gains rate or the ordinary income tax rate, plus an additional 3.8%. And usually that amount is going to be just on the income generated by the investment income. So there's two ways to calculate it. It's either the amount of your AGI, that the lesser of the amount of your AGI that's over 250, or your net investment income, which it usually ends up being your net investment income.
So if I'm hearing you right, just for clarity for the listeners here, 250, that we're up in the 24 bracket at that point. And I say I'm married and I make more than 250. So now I'm in the 24 bracket. And if I have CDs, or if I have, capital gains, my CDs will be taxed my CD interest would be taxed at 24 plus 3.8 for the NIT tax.
Yeah, essentially.
Okay. Capital gains, instead of 15, I'm probably going to be at 18.8.
Yeah, you're at 18.8 at that point as well. So that's going to be a factor for the high income earners, and that's kind of the percentages or the tax rates that we were using here. So that brings your 5% yield down to a net yield of 3.61% after federal taxes, after net investment income taxes. So I mean, it takes nearly 1.5% off of your actual net yield from that CD payment, which is a significant amount. So, that's why for that high income earner, if you're, still working, still generating a lot of interest, a lot of dividends, a lot of, phantom gains, we'll get into that in a second, you might need to look at a different strategy. I think I told this story on the radio a couple weeks ago, but I ran into a situation recently where, someone just was really risk adverse. They didn't want to invest anything, and they kept a ton of money in cash, and it just generated a ton of interest. And they had the ability to make Roth IRA contributions, and they weren't doing it. And, what I was telling them is, hey, I would rather you just have your cash, CDs, whatever, in your Roth IRA, if you can push between, you and your spouse, $16,000 this year, and make a contribution for last year, push $32K in there. And so it's not hitting your tax return every year while you're still working, than just having it in a bank account generating interest. It would be better to even just have it sitting in there. So I think when you get into those high brackets, even though having some interest sounds great, you do need to think about how you're generating it. And if you can generate it more in tax deferred vehicles, or, retirement accounts, things like that, it's going to help most likely your net yield be higher in the future if you're pulling out at lower brackets.
So your 5% gross, if we're talking a CD here, 5% gross now, after our after tax yield is now down to 3.61.
Yeah.
And I think in your example here, you have $10,000 of total interest. So if taking that same example, I don't think you just said this because I'm calculating math too as you're doing this and looking at it. If we're generating $10,000 of interest and I'm in the 24 bracket and I'm also in the NIT bracket, I'm at 27.8. That's $2,780 of federal income tax.
Yep.
So a lot of times we've been in meetings with families and we're talking to them about their tax return. Did you get a refund? Did you have to pay? Oh my gosh, I had to pay and it was several $1,000s. And by the time you go through that return, you start to understand why they paid that. They're getting an excessive amount of interest from CDs, interest from high yield money markets. Maybe they have placed money in other investments that are generating ordinary income tax, which is costing them yield after taxes, but it's also costing them more in federal tax. And I think that's where Graham, I think our team does a really good job at identifying that. Our report card actually will identify that. Our advisors know and staff, I know because you and I helped create the card here. It helps us really identify and really uncover that and show that to a prospect that comes in to see us.
Yeah. And, at that point, it's about, how do we still generate a good yield? Because, I would say it's better to generate $10,000 of interest that are taxable than to not generate any interest on your money. However, you probably have some better options of how and where you can be generating that interest, even if it just means, rebalancing your total portfolio to have, a little bit more of those interest yielding, high dividend yielding kind of positions and, deferred accounts, or there are some other things as well. So I think that's kind of the first element. Now, getting back to the mutual fund side of things, this is a very similar example, but we're going to be dealing with a mutual fund here rather than a CD. So mutual funds, actively manage mutual funds, as we talked about a little bit ago. There is a fund manager and they'll go in there and they'll, move things around, sell certain positions, buy other positions. And when that happens, even though it's inside of a fund, it is considered a capital gain to you as the holder. So a lot of times we'll see similarly, someone will come in, they'll have us do an analysis on their, taxable brokerage account. They'll say, hey, I got $1 million in this brokerage account and I'm paying a lot of taxes and I don't know why I'm owing. And it's like, okay, well, you had $70,000 of capital gains last year. Did you know about that? Did you sell something? Oh no, I haven't taken any money out in 10 years. Well, you probably had fund managers going in and selling things and moving stuff around, and that can generate short and long-term capital gains. So using an example here, taking a portfolio that has basically a capital gains distribution each year of 4%. So every single year, 4% of the account balance is going to be distributed. And I'm using the same dollar amount as the CD, which is $200,000. So $8,000 every year is going to hit this person's tax return. Same person, they're in the 24% federal bracket and their AGI is high enough that they have to deal with net investment income tax as well. So each year, this mutual fund is going to generate $1,500 of taxes owed, $8,000 of taxable income in capital gains, essentially. And so using an 8% rate of return as well. So your after-tax return goes down to about 7.2 over that course of time. So if you're going to look at that over 10 years, so 10 years, you get 8% a year, but 4% is distributed in, capital gains, or at least 4% is taxable. At the end of those 10 years, your account balance would be around $398,000. Now, if we were going to look at a second example of having, 8% growth a year, same amount on 200,000 for 10 years and not distributing any capital gains, so like an ETF that doesn't distribute capital gains until the end of the 10 years, the final value would be at about $431,000. So, it's about a $33,000 swing over 10 years, just because of the fact that you're going to have that tax drag every year. If you were, had the $1,500 of taxes owed because of those capital gains distributions. And to take it a step further, if you added a 0.5% fee, it brings the difference to about $50,000 over that 10 years between the ETF and the mutual fund instead of 30. So again, I think it's just one of those situations where you're kind of investing in the same thing, getting the same return, but you might actually be netting less at the end of the day. I just think it's kind of that second component of the mutual fund versus, an ETF. In this scenario, we're talking about taxable brokerage. So I appreciate you guys for bearing with me with all those numbers.
I'm drowning in the math over here.
Yeah.
So I think just to kind of sum this up for the listener today, there's a couple of lessons in all that math, which, by the way, great stuff there, Graham. I have a copy of your notes, and this is excellent. This stuff, we run into this all the time. And this is part of our coaching when we're meeting with prospects in the office, is kind of how to fix this. Number one, you need to understand where you're at in the tax brackets. If you take a look at the IRS tax code, it's a spider web of tax thresholds that you can get across. So you have your marginals, you have the NIT brackets, you have the capital gains brackets. If you're over 63, you start to have to worry about the IRMA brackets. So it is a spider web of tax thresholds that you need to be aware of. So number one, understand where you are in the tax brackets and what the impacts are relative to the type of yield or interest or dividend that you're getting off of those investments, even if they're CDs. CDs feel good because they're safe. They're with the bank. Banks are FDIC insured. I can lay my head down at night and sleep. The IRS says, great, thank you for laying your head down. Now I'm the Sandman. I'm going to come take some bigger tax chunks out of your tax return there. So you want to be careful there. Number two, holding mutual funds in an after-tax account or a non-IRA account, we call it non-qualified, can be dangerous because, as Graham noted, there is the potential, and this especially happens when the markets are way up. So there's two distinct years that I remember it happening. One was last year, markets were way up. It also happened in 2021 as well, when the market was way up, where essentially around the end of the year, the mutual fund manager, they've had a lot of gains inside of that mutual fund, and they do some shifting around. And essentially, you as the owner of that fund, you get hit with those capital gains taxes, and you didn't do anything. And what happens, this is where it becomes a complete surprise, because sitting there when you get ready to do your taxes, you're like, okay, we didn't sell any of our funds. We did what we were supposed to do. We held them and they grew. And then you get a 1099 in the mail and you start entering in those gains that they did that you got kind of penalized for, if you will. You didn't do anything. So when holding mutual funds, it's best if you're going to hold mutual funds, and we're not anti-mutual fund, but we can make an argument that there's a lot of more cost-effective funds out there on the ETF side than to hold mutual funds. But if you're going to hold anything in a non-qualified account, then we would recommend ETF over a mutual fund all day long, just because you don't have that phantom gain potential that Graham was describing there, because it is a reality. We've had people come into the office to do the discovery session with us, and they're upset. They're heated because they got a big tax bill. And sometimes, like when you're holding a lot of money in those funds, it will light you up when you finish the return. Not only will it light you up in terms of the money you've got to pay out, but it also send that angry thermometer really high, and it causes some pretty big anger moments there. So the best thing to do is set up a time to come in, sit down with us. We will walk through how you're currently invested. We'll do an analysis. We'll take a look at the tax side of things, and we'll put you through our Rite Retirement Report Card. And that way we will be able to identify and actually teach and coach you on what you should be doing to make your retirement and your tax situation more efficient as you walk through the preparation for retirement, or even if you're into retirement. And you can start that discovery session by giving us a call at 256-937-2010. Again, the number is 256-937-2010.
Market difficulties can be unsettling, but your retirement plan doesn't have to be. Take control by calling Cris Wallace at 256-937-2010.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
If lingering doubts like, have I saved enough? Or will my retirement funds endure? Are on your mind, it's time to consult with Cris Wallace. Text VISIT to 256-937-2010. That's 256-937-2010 to book your appointment and get the answers you need.
And we thank you so much for joining us today. You're listening to the Rite Retirement Show. I'm Luann Fulmer here with Cris Wallace and Graham Bauer, both of WG Financial Group. Cris is president. He's a certified financial planner and financial advisor, as well as Graham, certified financial planner and financial advisor at the firm. Here's our phone number again, 256-937-2010. Call. You can text the word VISIT if you prefer. And remember, you can find us online at wgfinancialgroup.com. on Facebook throughout the week when maybe something hits the headlines after this show. Cris will always update things there. So, of course, search on Facebook for WG Financial Group 256. And this show is available wherever you get your podcast, Spotify, Apple, wherever. Just search for the Rite Retirement Show. And again, thank you so much for joining us today. So if you think about it, so many of us have spent decades preparing for retirement. Like you guys were saying, we've been diligently saving in our 401ks, and then we watch those accounts grow and feel so good about it. But as retirement approaches, some challenges emerge. And that's what I want to talk about right now, how you guys actually help people when they're having to transform their savings into that reliable monthly income, okay? That monthly paycheck, the retirement paycheck, and that check has to last a lifetime. So let's talk about that. Cris, I'll start with you. Tell us how you help someone make that transition from saving to spending, because it is challenging for retirees. Talk about that, please.
Yeah. So we had some show notes and you sent those over this morning. So we'd have some kind of topics to discuss. And I didn't really know until shortly before the show what we were going to talk about here in this particular segment. And I received an email, and the email reads, FYI, I'm headed to Panama City Beach, Florida tomorrow for 5 nights. I found an Airbnb that will allow me to take dogs. So he says, take care. Yeah. So this is one of my emails from a client. Yeah. And this particular person obviously can't say names or anything like that. He struggled with the transition, the psychological shift that it takes to go from consistent paycheck to, spending and traveling and doing things that you really want to do, but you're afraid to do because your mind won't psychologically, you can't get over that psychological hump. Yeah. And I was so happy when I received this email, because one of the things that I've done with this particular person is I have him for a little while, I have him on quarterly sit downs. And, our last quarterly sit down was just, hey, everything's great, just more or less, you could almost call it like counseling a little bit, just to say, hey, it's okay to, you have a plan. It's okay to go out and spend. And, part of what we do at the office is some counseling from like a psychological standpoint that tries to help a family or an individual really determine, or really, I guess, in their mind, give themselves permission. And I've had to tell people in the past that, you have enough money, you have to give yourself permission that it's okay to spend this money. And until you give yourself permission, you're not going to, and it's going to be, I won't say it's going to be a life of misery, but it's just going to be a life of kind of stress and worry. So the key thing is building a plan, building an income plan, one that will allow you to give yourself permission so that you can go out and spend your retirement assets. Because that, we've talked about this a number of times on the show, but, you go from receiving money from a paycheck it gets deposited into your account. And part of that you put into your savings account. It's just habit. And now in retirement, you no longer have the faucet of income, as we call it. And now you're going to pull out of your savings. And it's just a weird feeling to a lot of people. And I bring this up because if I told you I've had this conversation just once, I'd be completely lying to you. It's had to happen multiple times. But the reason I bring up the story is because I just, received the email, and I'm happy. Like I'm happy that he's going to go out and he and his wife are going to go and they're going to enjoy the beach. And I'm kind of jealous at the same time that they're going to be at the beach and I'm here at the office. And he's with his dogs, and I love my dogs as well. So it is a big psychological shift, Luann. It does help, or at least I feel like it helps to have someone walk the journey with you. Now, whether that's us or someone else, we don't care. We just want families that listen to the show to partner up with somebody, a financial advisor, somebody that can kind of help give them good retirement advice. There are some advisors that I feel like focus on things before retirement. I feel like when you get to retirement, when you've got to worry about taxation on your withdrawals, Social Security, Medicare, it's good to find a firm like ours that focuses on retirement so that you can, have that confidence and know that that's what they focus on and really can help you.
Yeah, we want you to play in retirement, and that's why you have to plan. And Chris and Graham are very good at helping you plan it out and helping you make this transition from saving to now you're in retirement and you get to spend that money. We want to help you spend it confidently. That's for sure.
Yeah, and one more thing I'll add to that, Luann, because one thing I tell people a lot is, how do you accumulate wealth? I think fundamentally how you accumulate wealth is you do not just spend recklessly and you save diligently. But how do you distribute wealth? It's very much the opposite of that. So for people who are wealthy, and a lot of people are wealthy and they don't consider themselves wealthy too. I would say that as well.
I've seen that a lot.
A lot of people will say, I'm not a wealthy man or I'm not a wealthy woman. And it's like, well, I think by a lot of people,
7 figures later.
Yeah. Oh, wow. What?
I think by a lot of people's standards, you did wonderful for yourself and good for you. But at a certain point, you kind of need to say, okay, how do I spend a little bit more? Because for those types of people, it's probably just not in their nature to do that. I don't think that a lot of people that accumulate wealth are just a spender, waiting to get out, just thinking, oh, when I retire, I'm just going to go crazy. I don't think that's honestly how people that save well think. I think they think more along the lines of, I want to save so I never run out of money. And they're thinking about that before retirement. And then they get into retirement and think, oh, now I can't spend this money because I don't want to run out of money.
Exactly.
So one thing I like to tell people to do is, sometimes it's just about some smaller changes in your lifestyle. If you're the type of person that, let's just say, goes down to the beach like you were talking about a second ago, Chris, a lot of people like to go down to the beach every year. Okay, so maybe you go down to the beach for 2 weeks. Go down for 4 weeks and get a place that's twice as nice as the spot that you usually go to. Rent a car that's twice as nice as the one you usually get. If you are someone who likes to travel internationally, maybe get yourself first class flights instead of, economy or business. Just changes that are not necessarily like, you might not be the person that wants to go and buy a mountain home in Colorado and a bunch of jet skis and snowmobiles and stuff, but you might like to do certain things and maybe just do a more elevated version of that. If you like to golf, buy into a nicer golf club, get some nicer clubs, buy some new polo shirts, anything like that. So I think those are the easiest changes to kind of make yourself feel more freely, because it's not really outside of your nature. It's just a more elevated version of the stuff you already like to do.
Treat yourself.
Yeah, I'm saying if it was me in that situation, I would probably just be tearing up the record stores and antique malls. But
I love it. I love that. Well, okay. A lot of financial professionals recommended following that 4% rule for your retirement withdrawals, right? Just make sure you make it safely throughout retirement. But, we've talked in the past, this approach isn't really adequate in our economy today, in our environment. So I'll give it this one to you, Graham. Tell us why this might fall a little short for retirees today, this 4% rule.
Yeah, I think the 4% rule has always been a good jumping off point, but, it's definitely not something that I would solely rely on. And I think it depends on your situation because, on the one hand, I think the 4% rule for some people could be a bit heavy-handed for reasons like, if you saved well, but you're trying to retire, much younger than the average person, in early mid 50s, and now you have a really long retirement time horizon. Or, if you need to rely on 4% of your account balance at retirement for the rest of retirement. So, for example, if you got $1 million and you're like, 40,000 a year is what I'll draw off of it based off the 4% rule. If you have to have that much, that could be a little bit of a dangerous place to be because, if the balance drops, now you're drawing more than 4. So there are some scenarios. And then there are other scenarios where, I think you could be probably a little bit more flexible than that. If you're someone, we've run into some people recently who have worked into their late 70s, early 80s. If you're someone like that, you can probably be spending a little bit more because you don't have 30, 40 years in retirement unless you have some really, really incredible genes.
Moses genes.
Yes.
Yeah, oldest man on earth. But, other than that, I would say in those scenarios, you could do a little bit more. So I think, or, if you're someone who just saved really, 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 really well, there's also more room in those situations too. So I think it really depends. I think it's a decent rule of thumb, but, when we're talking to someone about how they're going to get retirement income, we're not really talking about like, okay, here's your Social Security, here's your pension, and here's your 4% withdrawal, that's your retirement income. We're more so backing into it for, what are your expenses? What's a comfortable amount of money to be spending? So if you're spending, let's say 80,000 a year now, and you're just like, yeah, we live a pretty simple life. Maybe we want to just keep spending 80 in retirement. And between your Social Securities, you're at like 60. We might not necessarily be adding a 4% draw there, just be adding, what do we need to get you up to 80? Can we do that comfortably? Is that withdrawal rate going to be too high based off your balance? Or, is that withdrawal rate going to be kind of low? And hey, maybe you should actually be spending $100,000 a year, 110. So I think that, it's a decent little rule of thumb to look at if you want to evaluate yourself. But for a very practical, more specific retirement income plan, I would definitely want a little bit more data than that.
Yeah, I think when we just look at the 4% rule, I'll just kind of add something to that as well, Graham. The 4% rule, I think, requires more of a dynamic approach where you can be flexible because there may be years you may not want to spend 4% because maybe the market's dropped off considerably. So it requires some flexibility. And then we often find, that people aren't even using the 4% rule correctly.
Really?
So, 4% rule, I guess to kind of sum this up from my point of view is it's a great rule of thumb. And I have found myself in a meeting before pulling out the calculator, just going, okay, where are they at relative to the 4% rule? Knowing that I'm probably not going to advise them to take just 4%, but I need to kind of know where they are relative. So I like the 4% rule as a good rule of thumb. Hey, you know what? In some cases, it's going to work. And a matter of fact, it may work in more cases than it does not work. But when you're talking about retirement and you really only have one shot to do it right, you do want to be careful and make sure that you've tested the plan in different ways and not just run off of a rule of thumb called the 4% rule. And there's been different studies. And I think Morningstar's done studies this has been way back in the archives, but I think like 2013, they recommended 2.9. And then if we get into the 2000s here, I want to say it's maybe 2020, 2021, something. They ran another study and it was in the low threes. Graham, do you remember? It was like 3.2, 3.3.
Yeah, they've run a few. And I think that's the thing where it's definitely very dependent on market performance in these types yields. Of studies and bond yields. Yeah, exactly. Yeah. So when you're looking historically, it's like, yeah, maybe if you retired in this 20-year time span, maybe you could have used the 6% rule. But if you're in this, 20-year span, maybe it would have been more like the 2.9. So, yeah, I don't remember exactly, but I think you're right. I think it was low threes.
Yeah, I don't remember either, but I know it was low threes because I remember walking around my backyard with my dog with my AirPods in, listening to the podcast. So I know it was low threes, but regardless, like I said, 4% rule, good rule of thumb.
Real quick, let's give out your phone number. I want to make sure as people are listening, they have this, because if you have your own questions about, what you want to talk to Cris and Graham about, they would love to hear you and to guide you. They are both certified financial planners and financial advisors at WG Financial Group, where Cris is president. And here's that phone number, 256-937-2010. You may call that number or text the word visit. And remember, you can find us online at WGFinancialGroup.com. Head there and find out even more about the entire team at WG Financial Group. They focus on retirement planning, and they would love to guide you. I'm Lou Ann Fulmer. Again, this is the Rite Retirement Show. So, this is so funny to me, but many times retirees are surprised by how taxes impacts their retirement income.
Lou Ann, can we, before we move on to that question, can I bring up Morningstar's withdrawal rate? So
go right ahead.
Just quickly mention that.
Sure, go ahead.
So in last year, the withdrawal rate, so 2024 was 3.7, was a good baseline starting withdrawal rate. And if we go back to 2021, it was 3.3, so low threes, like we said. 22 was 3.8, and in 23 it was actually they don't have 23. They just have they have 4% in 24. 3.8 was in 23, sorry, and 3.7 and was basically last year. So I don't know why they have 4% and then 3.7. So regardless, it's not quite 4%. It's a little less than 4%, and many of the last studies that they've done there.
Yeah, and I guess the only other thing to mention there would be that, like, typically when you're looking at these numbers, that's also not a number to get you to exactly $0.00 on the day that you die. Yeah. So in those projections, even on that withdrawal rate, like, there's still going to be money left over. Mm-hmm. So for people who inheritance is not a goal at all, maybe that's a slightly different factor too. But just worth mentioning so people don't think, that's with leaving nothing behind.
Yeah. And the other thing I will mention this before we move on to your next question, Lou Ann, is that we do encourage people to spend more early in retirement. So that might mean that you take a little bit more early on in retirement, because the likelihood of you reducing spend in your latter years for living expenses and fun stuff is very likely. You're just not going to feel as well. Maybe your body doesn't perform and hold up as well. And so you may end up just spending a lot less later, and especially when you get into your 80s. I always tell stories where I remember as a kid going to my grandparents' house. I think I've told it on the radio before. She would have these Charles chips, and they were in like the big tin can.
Yeah.
And I love those things. But she would always have like oatmeal patties and just lots of stuff over there. And then by the time my grandma was like 85, I would go over and she'd have like in her refrigerators be just like sweet tea. That was about it. And some lemon juice. My grandmother was real big in putting lemon juice in her sweet tea, which, that's how I do it because that's how I was raised. But yeah, the refrigerator was just empty. They just didn't have the food that they had early on.
Because they couldn't afford it?
No, it wasn't
just
a matter.
They weren't eating
Lord,
it.
no, it wasn't because they couldn't afford it. It was because they just didn't eat a lot.
They didn't eat it.
They just spent less on groceries, and they just don't eat as much. I always like to say my grandmother ate like a bird. It was just nothing. So yeah. Anyway, we do encourage people to spend more. Plan, retire, play. We want you to go out and play early on in retirement for sure.
Yes, that's for sure. But one thing I was saying that retirees are surprised by, which kind of cracks me up, but taxes actually, impact their retirement income quite a bit. So talk about that, how people need to kind of keep that in mind, factor in taxes when you're planning on your retirement income.
Well, Graham went over this in great detail in the first segment. So if you're listening and you're catching the tail end of the show, then you'll want to definitely hop back out to Apple Podcast or Spotify and pick up the whole episode, because Graham goes through some numbers like a nerd. And I mean that in the most complimentary way. It was a lot on the taxes. So, good stuff. Once you reach retirement, typically you have everything paid for. So you're not itemizing, you're just using the standard. So you don't quite have the same amount of itemized deductions. Not that that's always the best thing either, but you just don't have as many deductions typically. When you're retired, you do still want to know where you are in the tax brackets, and you want to understand how income is taxed. So as Graham noted in his examples, if you have CD interest, that's taxed at ordinary income tax rates. You want to know that at worst case scenario, up to 85% of your Social Security could be taxed. So you want to know that. And you want to know, do you have any room to be able to pull out of a traditional IRA without any tax? And if you can't, what is going to be the tax rate there? And if you do a conversion, what do you have access to right away in a Roth conversion when you go from traditional to Roth and you pay the tax? How much of that do you have access to right away? So I think when you're in retirement, there are several tax considerations that I feel like families should look at. And again, our team knows kind of what to tell you. Like, you should pay attention to this, and you should do more of this and less of this and pull from here, just by building out the plan. And again, we use a Rite report card that helps point everything out to our advisory staff. It also kind of helps it lay it out for a client so that we can start working with them in an efficient manner and really start coaching them, because like I said, there are a lot of considerations for taxes you got to take into account.
You want to be smart about it, right? That's the biggest thing. You want to be educated and make good decisions when it comes to taxes. Because something I'll hear people say that, I understand the sentiment, but I would say I don't totally agree with it, is like, oh, hey, if you got $1 million in your traditional IRA, you only really have, $700,000 or whatnot.
Bull.
Yeah. And it's like, okay, yeah, if you had $1 million expense that you needed to pay and you had to cash it out, and
right,
you owed money to some crime organization and they were knocking down your door, maybe that's true in some regard. But for most people, you're not withdrawing the entire balance of that account in 1 year, paying it all in the maximum tax bracket and just leaving it all in cash. Yeah. So in reality, if you're smart with it, if you have a income strategy, a Roth conversion strategy, maybe a QCD strategy later down the line, it's probably going to be much, much less than that over, a 30, 20-year retirement, something like that.
You just hit a nerve, because I've heard people on the radio
I hear that all the time.
Say that.
Yeah.
Where if you have $1 million, you don't own but 70% of it, or 65%, whatever the number is they use. And that is just the furthest thing from the truth, because there is efficient ways to withdraw money out of a portfolio. And to your point, if you have this $1 million emergency need, which I don't really know what that would be, that'd be a pretty strong emergency need to need $1 million at one time. And then of course, you're going to be in the highest tax bracket possible. But, I can't stand it when I hear that. And we hear that, I've heard it on the radio, but I've also seen it on reels too. We do the real talk at the end of at the first segment. And I've heard that on reels before. It's like, you don't own all your 401k. Well, actually you do. And you actually have a choice on how you're going to withdraw that money in a lot of cases, and doing it in a tax efficient manner where you're really limiting the IRS's hand in your proverbial pocket, if you will, taking tax money away. You do that with good planning. And like I said, you didn't hit a nerve, you personally, but the statement, because I've heard that a number of times. And it's, I think it's just bad advice. I think it's fear-driven stuff. Yeah,
it is. It would be a way to make you feel like, even if you thought you had enough saved, that maybe I don't actually have enough saved, because I saved $1 million, but I really only saved $650,000. It's like, no, you did save $1 million. Yes, it will be subject to taxes. That is a reality. So it's not like I would plan to not pay any taxes on that money. But at the same time, it's like for the average retiree, you're probably looking at an effective tax rate of generally like somewhere between 0 and 15%. You're not typically seeing your average retiree having a, way up in the 24% marginal rate, high effective rates. It's just not something you see a lot unless you have a ton of income. So.
Right. Or a ton of income, or you didn't spend or convert any of your money before RMDs, then you might get that. But I tend to agree with you there, Graham. I think effective rate somewhere between 0 and probably 10 to 12 effective, which, just for those of you listening, effective is just basically the average tax that you're paying across all the brackets on all your income.
So, when you think about it, when people are approaching retirement, they're excited, but they're also concerned, because today we're living a lot longer, than ever before. And the big worry that stands above the rest is, am I going to run out of money? Right? You guys hear that all the time. So, guys, tell us about the strategies that you guys would, introduce to retirees so that they can create that reliable income stream that can last a lifetime. Kind of walk us through that, please.
Yeah. So I'll kind of start it. I'll let Graham kind of fill in any gaps here. But first of all, I think it makes a lot of sense to make a good Social Security decision. And I know there's people that would want to argue listening to the show But we're of the mindset that you make a very data-driven decision with Social Security. One of the things that we don't like to see families do is collect early while someone's still working. So let's say your wife or spouse or maybe your husband is 62 and maybe you're 62 and they're not working, but you are, and you're making $180,000 a year. We would say don't collect. Well, it's their money and they want to collect it and they can spend it. Yeah, that's fine. It's just going to increase your tax liability. It's going to stop the growth. And 85% of it's going to be taxed. So right off the bat, 85% of it's going to be taxed at the 22% rate if you're making $180,000, for example, there. So making a very data-driven decision on Social Security, because we know that that is the foundation of a lot of families' retirements. It really is. That is the guaranteed stream of income. It is COLA adjusted, cost of living adjusted as well. So that would be step one. Step two, if you're fortunate enough to have a pension, make a good data-driven pension decision. A lot of pensions that we run into out there today have survivorship options. So you want to make sure you're picking the survivorship option that's best for you and your family. And then that way now you've got Social Security and a pension. If you don't have a pension, then I think you have to start looking at other sources of income. If the gap between your guaranteed income and what you're spending every month is rather large, and we like to say that, it's great to have 80% of your income covered by guaranteed income, or 80% of your expenses covered by guaranteed income. If you fall short of that, then we have to start paying attention to what we talked about earlier, Graham, was the withdrawal rate. And if that's pretty large, then I think we got to start looking at some very stable sources of ways to generate income that's guaranteed in retirement that really extend the life of someone's retirement. Because the tricky part is about retirement is we know when we're going into retirement. Well, most people do. I mean, you can be laid off or come down with an illness, but by and large, most people know when they're going to retire. It's when you're going to retire from this life is the big problem. So you want to make sure that you have enough money that can outlive your life, so to speak. So understanding, how much of that needs to be guaranteed, where to withdraw it from. I think those are key things there. And then you plug all that into a plan. And what the plan does is it helps give you confidence. It gives you confidence. And like I mentioned earlier, essentially giving yourself permission to spend. And once you're able to do that, then you can kind of go on and live life. You've got normal paychecks coming in, on a every month basis or every other week basis. We do it sometimes every other week for some people because it feels like a paycheck to them. And that's, when you get into retirement, there's a lot of feelings involved, and you want the money to kind of feel the same. You want to go into retirement. You want to be able to spend at the same level because that's your lifestyle you've been living. And then you want to recreate those income streams to feel like your paycheck. So those are kind of my thoughts on the income sources, Graham. I don't know if you have any additional thoughts there that you may want to add here.
Yeah, I mean, I think you really hit the nail on the head, but, just making sure that people feel comfortable recreating that income stream is so key, because you want to go out and enjoy yourself. You don't want to feel like, you don't want to feel like you have to go back to work or be scared all the time. So I think that, setting up that strategy is, invaluable.
Yeah, I agree. And I looked at the clock there. Actually, I pointed at it while you were talking, Graham. So we are out of time. Luann's probably over there like going, guys, we got to wrap it up. We got to wrap it up. So Luann, appreciate you being here. Graham, always appreciate your input. Great numbers on the tax stuff, by the way. That was awesome. That was actually really, really awesome. So hope everybody enjoyed it. Hope everybody out there has an awesome and blessed week. And I will give our number out if you would like to set up a discovery session. 256-937-2010. The number again is 256-937-2010. And as we go forward this week, throughout the weekend, next week, always remember to serve every person in every situation with a servant heart.
Investment advisory services made available through AE Wealth Management, LLC, AEWM. AEWM and WG Financial Group are not affiliated companies. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Financial Group are not affiliated affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only and is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. WG Financial is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial. This radio show is a paid placement.